One earnings report, two setups firing on the same bar, a day trade and a swing, and a single rule that kept us on the right side of a 40-point run. This is NVIDIA, May into July 2025. May 28th, after the close, NVIDIA reports. The next morning, it gaps from 134.94 up to 142.06. This is where two setups line up, but the order matters. First, intraday, his oldest play, the one he wrote about back in 2007. Chase the gap or wait for VWAP. Here's the trap. May 29th gaps up, runs for 4 minutes to a high of 143.29, and then it rolls over. Watch the VWAP line. Around 9:44, price loses it, and it never gets back above. 22 minutes in, the exact moment Brian likes to buy. Price is 141.69, under VWAP at 142.18. There's no reclaim, so there's no buy.
So this is what I call chase the gap or wait for VWAP, is what we're building into a strategy as well. So the stock gapped up, it ran for a few minutes, pulled back, then it gets back above that daily price, average price, 22 minutes into the day. So that's where I love to buy gaps.
The gappers who chased 142 got trapped. And the volume tells the story Brian always points to. It peaked on the opening euphoria and again on the capitulation low at 137.72, which actually pierced the lower VWAP band. That's not a buy, that's a washout.
Stop underneath the low of the day, and 60% of the time it won't violate that. 40% of the time it will, but it's a real nice tight stop.
Now, June 3rd, the same setup, but this time it works. NVIDIA gaps up, builds a quick base, and reclaims VWAP. 22 minutes in, price is 139.54, sitting above VWAP at 138.37. That's the trigger. And here's the confirmation Brian wants. Volume expands into the move. A 1 million share bar at 9.56, another 733,000 at 10.02. Price riding a rising VWAP into the close at 141.02. May 29th, price fell on fading volume. June 3rd, price rose on building volume. Same chart, opposite message, and VWAP plus volume told you which gap to trust. Buy the reclaim, stop under the low of the day. On June 3rd, that's 350 shares near 139.50, with a stop at 138.20 just under the low of day. That's a risk of about $455, less than 1%. The bigger money is the swing, and the earnings anchor is the spine of it. But notice what you do not do. You don't chase the May 29th gap, and you don't buy the May 30th dip, because that dip flushed to 132.73 and would have stopped you cold. You wait. You let the average buyer, since the reports show you who's in control. Don't buy the dip. Buy strength after the dip.
And I always say, no, don't buy the dip. Buy strength after the dip.
So why does that anchor matter so much? Because of who's defending it.
Is as it pulls back to that volume-weighted average price from the earnings event, that's where we're benchmarking our trades from, because that was the event that shifted supply and demand. And that's what we're looking at. Is
when a stock pulls back to the volume-weighted average price from the earnings event, that's where the institutions benchmark their orders, because that was the event that shifted supply and demand. By early June, that earnings anchor sits around $137 to $138, the volume-weighted cost of everyone who bought since the report. The moment NVIDIA reclaims 141 on June 3rd and holds, the average buyer since earnings is winning. Bulls in control. That's the tell. 350 shares near $139, and now the stop is structural, $135, just under the June 2nd higher low. Our risk on the swing is $4 a share, about $1,400 or 1.4%. And here's the only exit rule he lives by.
And if it breaks below it, that's my cue to get out, because now the average person over that month since the event is now in a losing position. The sellers have the opportunity to take control.
The first daily close back below that anchor. If it breaks below, that's the cue to get out, because now the average buyer since the event is in a losing position and the sellers take control. That close never came. From the June 3rd reclaim, NVIDIA rode the rising earnings anchor to about $157 by the end of June and roughly $177 by late July. And every pullback held the line. That's about 4.5 times our risk by the end of June and nearly 10 times our risk by late July. One report, one anchor, one rule, a $455 day trade that became a $13,000 swing. Setup number 1 told us which gap to trust. Setup number 2 told us how long to hold it. In video 3, we flip it. We anchor from the high and learn where the short sellers feel the pain. Don't buy the breakout, don't buy the dip, buy strength after the dip. See you there.